Is China's growth model sustainable? Welcome to the call. I'm Jay Sapsford. China has built the most impressive manufacturing sector the world has ever seen. Over the weekend, officials claimed the economy is growing at 5%. But demand is lagging, debt is surging, deflationary pressures are building, and a property hangover is dragging on confidence. The response? The world's second largest economy is doubling down on what many see as an emerging market growth model, exports driven by targeted investments with very little relief for consumers. All of which raises a question with huge stakes for business. Can strategic investments alone lift China's economy? Joining us now is Dan Rosen, co-founder of the Rhodium Group. Dan, welcome to the call.
Jay, it's great to be here with you today.
Let's jump right in with the growth numbers. What's the current state of the Chinese economy? I wonder if you could also touch on the growth numbers that came out over the weekend.
Yeah, emerging markets always have more debatable GDP numbers than the official statistics suggest. China's not unique in that regard, kind of normal. It's harder to count in less developed economies. However, in China's case, over the past decade, the numbers have gotten more and more problematic. And so much of the anecdotal evidence we have and proxy evidence we have has gotten way out of kilter. The turning point was 2021 when the property sector, which had become responsible for 20, maybe 25 or even more percent of overall Chinese activity was related to property, went off a cliff in a way that everybody could see. And so since then, especially 2022, last year of COVID, acute COVID for China claimed it was growing a little bit. We thought it was negative. Bring that up to today, China continues to report each of the past 3 years that it's hitting its target of around 5%, whereas to the best of our ability, we can't find anything that explains, in the case of 2025, somewhere around maybe 2.5% annual growth. So it seems to be about, really half of what China is reporting that an independent economist, including Chinese, when they're speaking privately, would say is kind of the ceiling.
Okay, here's what you say in a recent report. We're putting up a little quote of this here. History offers no examples of economies that have recorded 5% real GDP growth while facing years of persistent deflation. We doubt China is the first. So you're skeptical of these numbers. What are your truth metrics? What do you look at to get a real sense of how fast China's economy is growing?
Yeah. Well, we're talking to many businesses at Rhodium Group. In addition to the public policy macroeconomic research we're doing, we are doing that in order to be of counsel to firms that are trying to anticipate what's going to happen next in the product segments they're in. So first and foremost is just talking to people on the ground who are planning for what demand is going to be. Another Rhodium lens, which is very powerful for us, is the credit lens. We do a tremendous amount of work to understand credit markets, which are real time. There's daily information on demand for credit and for money. Demand for credit in China right now is at an all-time low. Firms inside the country are simply not asking to take on new borrowing, to do new investing. They're not behaving as though the economy were growing at 5%. And then, of course, we look at household fundamentals. Are the demographics okay? Are household incomes rising? Are households using their credit cards rather than paying down any revolving consumer credit they have? And all of those ways of checking things tell us that there's not growth taking place, that the only engine in the Chinese economy that's really firing well is on the net export side.
So is it correct to interpret that as a what some have called a balance sheet recession, in which everyone is so busy paying debt that no matter how much you lower interest rates or encourage the creation of credit, people are too busy writing down their debt that's been accumulating over the past few years?
That's definitely part of the Chinese story. We generally don't lead with that because looking back at Japan's experience and thinking, which is what people mostly comes to mind when people say balance sheet recession, what it took Japan about 12 or 13 years to work down its excess property balance sheet, China did in 3 years' time. 75% decline in property activity. And so it's just the dynamics in China are very different. Japan, when corporations had their quote unquote balance sheet recession. Japan was one of the wealthiest countries in the world.
Right.
China is still only at $12,000 per capita, and there's like 600 million people who are still making closer to $2,500 a year. And so a lot of the ways you'd guess what happens next in China in terms of the political dynamics, uh, overweighing sort of the Japan story is probably going to mislead you rather than tell you what to expect next.
Just very quickly, you mentioned that property investment was 25% of GDP at one point. What is it now?
Well, let's put it this way. In 2021,
Mm.
uh, 1.6 billion square meters of property was under construction in China. Today, the number is around 500 million. So we've had a more than two-thirds shrinkage of real property activity, and prices, growth rates continue to fall, not recover. This is one of the big differences of 2026 compared to 2025. As we came into 2025, property was starting to stabilize. Government fiscal support for the economy was actually pretty positive.
Mm.
And subsidies for appliances, automobiles, consumer subsidies were voluminous. Coming into 2026, all three of those things are no longer putting lift under the wings. Property is back to falling again. There is no fiscal wherewithal in a country that already has 9% of GDP government fiscal deficit properly counted. And those subsidies for appliance trade ins and cars brought demand forward into 2025, but they're no longer being offered to Chinese households. Those subsidies have been wound down. So a lot of the things creating a little bit of tailwind a year ago are not presently in place, which is why we're so anxious at Rhodium about how bad 2026 could be.
Now, Dan, we're putting up a chart here from a report that you released a few weeks ago. Output from the so-called old economy, we're talking combustion engine cars, property infrastructure, that's declining, while output from the new economy, robotics, solar, batteries, is growing. Is the new economy enough to make up for the decline in old economy output?
I think tech bros everywhere in the world, Jay, want to believe that that could be the case, that whatever disruption has been caused to, the old reliables in an economy, there's so much cool new stuff happening in electric vehicles in China or say AI in the United States, this sort of thing, that it's going to make up for whatever has come off. In China, it's absolutely not the case. As you can see in the chart you just had up, we detail this in a note that I'm more than happy to share with all the viewers looking at this podcast. Um, the size of the property sector downturn, the traditional internal combustion vehicle downturn, and as I said before, there's just not enough fiscal wherewithal in a government that is already having trouble taxing people because there's so much domestic slack, can't borrow that much more than it's currently doing to continue funding infrastructure. Those together are 6, 8, maybe 10 times the marginal value of the increase in the new three high tech sectors that you hear a lot of people trumpet as the source of China's future. Even in the current GDP numbers, Jay, that you mentioned at the top that we just got over the weekend on China's fourth quarter, the services sector in general, which in an economy going through middle income transformation, services should be going up, even while old industry is declining. Services are quite weak, according to the official data that's been offered right now as well.
What are the implications for employment on this shift? I mean, the old economy, as it declines in output, I presume is going to leave a lot of people without a job. Is the new economy, at least on the employment front, enough to pick up that slack?
Well, I mean, certainly not advanced manufacturing, because one of the magics of manufacturing is that you're dreaming of black factories where there are no people, or fewer and fewer people working in those facilities, more and more robotics. Now, when we talk about new economy in the West, we're generally also talking about labor-intensive services, healthcare, education. Of course, China has benefited from delivery services, quick delivery, kind of distribution of products. Um, but that's not where China is putting its policy emphasis right now. When you hear government talk about supporting the economy, they're mostly talking about these high tech sectors of China continuing to de-risk anything it gets from the world. Say photoresist for making semiconductors is a hot one this week that we're thinking about a lot right now. But those are not the labor intensive things. The labor intensive things Somebody coming out of college in China does not want to get a job as an electric bike delivery guy, getting people their lunch quicker. Right.
Right.
So that has already absorbed a tremendous amount of labor in China. It really cannot be the source of employment gains in the near term, I would say. And we see it in the youth unemployment data that actually things are getting worse for the under 30s, not better at this time, despite the fact that a 5% growth economy, if that were true, would be absorbing a lot more labor than it is.
All right, and those statistics seems to me would have enormous implications for consumption. As a percentage of GDP, consumption in China is about 39-40%, depending on who you look at. That's really low compared to a global average of 60%. Now, you and others have said that consumption at that low level is simply unsustainable. Or it's a model that's based on that is unsustainable for future growth. And I just wonder what the thinking is behind that.
Yeah. Well, as we were discussing before, history offers us no examples of countries that have grown well while they have deflation for 30 straight months. In the same way, history has no examples of nations that have made it through the middle income trap or phase without seeing a rapid increase in household consumption or government consumption, which means government paying for people's healthcare, education, things like that, relative to investment. But when you look closely at the next 5 year plan that's on the table in China today and the shorter term 2026 policy response plans that Beijing has offered us, it's really all about doubling down on high tech investment on the supply side for business investment rather than for unleashing household consumption. We've done some very long publicly available studies on what it would take to get household consumption really off the leash in China. Probably don't have time to detail it right now, but suffice it to say that what we see happening in Beijing right now are not the things necessary to really set us down the path to more sustainable household consumption growth into the future.
So it seems like the focus is on exports. And I've got a question here from one of our members. Is China basically seeking not only to export its way out of its economic challenges, but also doesn't Beijing want to reduce imports in the name of self-reliance?
Absolutely. They are very clear. They want to reduce imports in a number of areas in the name of self reliance, especially things that can be construed as choke point technologies that they wouldn't be able to source someplace else. I mean, when it comes to canola from Canada, they can switch that to the US or South America or other parts of the world in a clinch if they have to. But when it comes to, we mentioned photoresist before, or ASML lithography machinery, the highest computer chips. They can't do that for themselves. Totally committed to reducing their imports of those things, no question about it. But also, they need a way to generate some cash flow on this trillions and trillions of dollars of sunk cost in manufacturing that they've already done. And since there's not enough domestic demand to absorb it all, they absolutely have to perpetuate this export boom as long as they can.
Well, that leads to the numbers that came out over the weekend, which seem to suggest that its trade surplus last year reached a whopping $1.2 trillion. How sustainable is that?
Well, it's not, right? I mean, this is global imbalances such as we've never seen. And even if the world were willing to capitulate to China's manufacturing power here, there's just not a way for the rest of the world to absorb China's excess capacity in manufacturing. And a good deal of the rest of the world, think about Southeast Asia, think about India, let alone reshoring and the desire to have manufacturing in Europe and the United States. This is not a sustainable pathway. Already, it's basically tipping over the apple cart in strategic thinking. Some of the extraordinary geopolitical behavior you see out of Washington, but also in Europe, Japan as well, is a reaction to China sort of revealing its cards that it really has no intention to stop overinvesting at home, thus forcing disinvestment on the rest of the world until somebody absolutely stops them from doing so. And that's where the current moment is so fraught because there's not a great sense of coordination among the other leading industrial market economies in the world right now, Jay, as I don't need to point out, which is really the only thing that could cause China to really shift gears, I think, very quickly on this overinvestment.
Well, it seems that the geopolitical turmoil that's emanating out of Washington that you referenced earlier might be even driving some of our allies and closest trading partners a little closer to the China camp. We saw
Mm.
Mark Carney from Canada visit China and come out saying stuff that was a lot less, that was a lot more friendly than what he said before in the past. And we've seen some other examples. The Europeans have come to some sort of an accommodation now with Chinese EV exports, from what we understand. I just wonder what you think of the
Mm.
future of China's ties with other countries other than the United States going to be going forward.
Really glad you asked me that, Jay. I mean, first let's keep in mind that I think those other G7 nations, OECD nations, have taken the choice to do this just a month or two before the United States intends to have a summit in Beijing in April, where the betting is the U.S. wants to have the best deal ever, as the Phase One agreement was called, and Trump won. And all signals, given the sort of toning down of the U.S.-China strategic competition over the past couple months, the President Trump intended to do something very similar to what Mark Carney announced. What people are talking about whether the Europeans are going to pursue here. But I think the Rhodium message to all these folks, and in addition to corporates and financials, we do work with governments, including a number of the ones in the G7 we're talking about here, is that even if China wanted to make big promises to another major economy, until or unless China fixes its own domestic demand problems that we've been talking about here for 15 minutes or more, it's not in a position to offer a deal. And so everyone wants the premise, the prospect of a big deal with China on some terms or another to be a reasonable notion. But honestly, until we see basic macro things fixed in the Chinese system, it's it's an illusion. It's not a reality. And so I do expect to see more of these kind of what we call superficial China accommodation deals taking place in the weeks ahead and possibly through the first half. But inevitably, the underperformance of China's domestic demand is going to keep pumping up imbalances in a way that's not going to make any kind of meaningful long-term deal or entente, I think, sustainable beyond in the near term.
What does that underperformance mean for China's Belt and Road Initiative?
Yeah. Well, for one thing, large swaths of the Belt and Road have been repaying debt service back to China at a much greater dollar value than new Chinese lending is going to them. That's correct for the continent of Africa. Rhodium put out a study through the Atlantic Council 2 months ago, looking at the underlying realities for Africa. At the same time, the United States, more than other G7 countries, but some of them others as well, have sort of unilaterally withdrawn from important parts of the developing world economy. Again, Southeast Asia comes to mind to some extent, and opened up space for Chinese firms to move in pretty quick and offer to make deals. I think if folks come to the conclusion that the US just doesn't care to be there in the world to be a major geopolitical player, it's going to create buying opportunities for new Chinese competitors to make up for the fact that they're not having domestic demand in China in their own home market. So they're super hungry to go out there and find some alternative. If there's a sort of withdrawal from that space from Washington, and the Europeans are forced to focus on their own home affairs as well, of necessity, I think it does, start to raise the question of whether there could be a fire sale opportunity for our new Chinese competitors around the world.
Well, so what does the weak demand in China mean for foreign direct investment into China right now?
Well, this has been a Rhodium specialty for 16 or 17 years now.
Right.
We've been doing a pretty good job at tracking direct investment flows into China and out. They have been very flat in China since the pandemic period. Um, Europe is a little stronger than other investors, but 85% of European investment is just 8 or 10 European companies. So
Mhm.
it's not really a general investment story. It's a handful of firms that have gone long China, are so entangled now that there's no way for them to hedge out. But again, as we said, Jay, the fundamental thing to keep in mind is that there is not strong domestic consumption growth in China today. And even on the investment side, you look at credit dynamics, firms are not investing to make new investments on the ground in China, that foreign firms are likely to get a chance to be part of the contesting those markets of the future. So if you kind of keep your eyes on fundamental data, it's going to tell you what you need to know. And then, of course, Rhodium does have its overall tracking. Whether there'll be a recovery on the investment to China, I'm doubtful of it. There is, however, a boom of Chinese outbound direct investment. And there's even some talk that one of the April outcomes between the United States and China might be a significant opening of the door in the U.S. to Chinese inbound investment as well.
All right. Well, there's so many other things I wanted to dig into, but let me ask you this as the final question. I consider this to be the big question when it comes to China. There's this seeming contradiction that I'm hoping you might be able to square for us. On one hand, we have gleaming cities, state-of-the-art manufacturing, powerful technology. Seems like China is set to keep dominating the world. On the other, we have deflation, weak demand, and demographic decline, which you've laid out so eloquently for us. For a business executive, either investing or competing with China, how do you square these two competing visions?
Yeah. I think, Jay, there are competing China pictures available, but, today's, I think, Wall Street Journal, several other papers, FT just today, have big pieces on once you drive 2 or 3 blocks away from that central business district in almost any Chinese city, there is unfinished property. It's really not that gleaming picture that Shanghai is one example. A few exceptions to that, Shanghai being an exception. But just for anybody who goes and spends some time, if you get out of a 1 square mile radius of the Ritz, you're going to see a much more mixed picture. And then from a business decision making perspective, you simply must not use headline official data to try to guide your expectations for what your business opportunities are going to be inside China today. You need to find a different way to do it. And not only that, but you have to consider that if growth is not going to recover inside China, how quickly is Chinese production and Chinese companies going to spill outside and start affecting your opportunities in third markets as well? So, of course, walk around, kick the tires. No CEO can do that on an entire country, not even a small country, let alone a country the size of China. So you have to figure out how you're going to operationalize this with a quantitative perspective that you can trust and rely on. Partly that'll be through the business community, what it does to crowdsource information about what's going on. I mean, I'd love to talk to you at Rhodium if you're interested about this as well. But really, I think looking at the right kind of macro analysis, the way that we've been doing here for the past 10 years or so, has been much more predictive of future demand conditions than taking China's official data and headline data at face value.
Well, that seems like excellent advice, and we'll put links to your work in our public version of this that we will be putting up onto social media. And we deeply appreciate you joining us today, Dan, and shedding light on this extremely important story. Daniel Rosen, co-founder of the Rhodium Group, thank you. All right, our audience has had their shot of informational espresso and is ready to tackle the day. For more questions on the Chamber's China practice, including the China Center, please contact the Global Intelligence Desk. Coming up next week, we'll have Robert McNally, president of Rapidan Energy, joining us to talk geopolitics of oil. Missed a live episode? Catch the replay on our website, LinkedIn, or on YouTube. And you can also listen to the call's podcast edition on Apple, Spotify, or wherever you get your podcasts. And thank you to you, our members, for joining us today. This has been The Call, brought to you by the Global Intelligence Desk, asking the right questions to navigate uncertain times.